The Federal Reserve still believes that inflation remains too high, but what does it mean for us as traders and investors in this current market? While everybody's writing articles about how we're in the mother of all bubbles, and of course markets are about to crash with recession fears, are we about to enter one? Well, based on the Jackson Hole Symposium and interest rate decisions, the bonds market is telling us something very interesting. We'll be discussing that along with our thoughts on stocks, commodities, and of course cryptos today, and also whether the S&P 500 can get underneath a key level. We're in the weakest 2 months of the year, yields are still rising, and of course Nvidia is doing something that most people can't understand. Well, welcome back everybody to the Daily Show, where we talk about the macro leading indicators and of course the hottest charts for the week. If you like anything to do with markets, make sure to subscribe and smash that like button if you find value in today's video. Let's begin by discussing what happened over the previous week. If we have a look, it does look like most stocks were up, but it was a bit of a mixed bag. And Nvidia in particular did well and then did very poorly. Yes, the earnings result was excellent, but at the same time, was the market a little bit too well priced in? We'll talk about that later up in today's show. But let's also begin with Jackson Hole Symposium and of course what we call the terminal rate. This is basically where it's expected that the Federal Reserve will stop rate hiking. We're back to 5.65% now, and we're getting closer to those pre-March crash highs. And what happened in March was, of course, something broke and central banks around the world had to come in and start supporting it. That changed everything drastically. This time around, we're back up and we're hitting at that 5.65. So will something break again? I think it might, and we'll look at why we could say that based on longer term yields. Let's also discuss flows. It turns out that yes, the bigger players are still technically reducing their positions, and we can see this by this small reduction in net purchasing. Are they still buying? Yes, they are, but they're buying in less quantity. We'll continue to update you if this changes, but of course the trend is usually a beginning, and we're looking for a turnaround in that to really say the dip is in and we're moving towards a new high. We also have our sentiment reports finally in, and it's showing that bears have taken back control of the sentiment reports, which could mean that this could be the low for the markets, or maybe we get one more low. But usually when we're starting to approach this 36 to even 40+% for bears, that means that we're getting close to an oversold market. We do know that we came off a very high. The 19th of July, I believe it was, marked the high of the S&P 500 and I think particularly the Nasdaq. And then we saw selling from that event, but now things have switched quite considerably. We'll be watching this very closely along with price action and the key points that we'll bring up later on. Here's an interesting quote about Nvidia. Goldman's Rubina says, "I was pinged more times during yesterday's market trading than any other trading in my 20-year career on Wall Street." You sure about that? Global Wall Street and those not logged into their IB have been reaching out with the same question. Why is the most important stock in the world absolutely crush earnings and close up by only 10 basis points on the day with a 400 basis point reversal in Nasdaq futures? Of course, relying on Nvidia. And it says here, this is a no rules market. There is a supply and demand mismatch, and these dip buys, we're already very full. How about we just call it what it is? And that is, of course, buy the rumor, sell the fact. Markets rallied so heavily into this news result that it had to smash expectations. It did so, but of course, it doesn't mean that it's actually going to hold the price for now. This is an absolute common retail trap. And although Nvidia is an exceptional stock and actually got cheaper as of the earnings result, it doesn't mean that it can't sell off for a little bit first before regaining its bullish stance. This is always what happens. Everyone gets FOMO'd in, and think about it. Everybody would have thought that this thing was going to the moon because the results were so good, and then it didn't. Let's talk about actually the moon in general, because of course the Magnificent Seven, as we've brought up before in the charts, before we go into some interesting stats in just a moment, have been doing exceptionally well this year. If these still turn around and they start to look weaker on the charts that we'll watch later on, then we need to watch out. So of course, we are really watching seven stocks most of the time on the market at this stage. If they fail, then things go bad. Now, what about stats? Well, we've got some updates here from Wayne, and I think it's pretty cool what he's done here. So we've gone through effectively the previous 10% plus January to August periods. Then what we've done is we've taken out, of course, the negatives, or what he's done here, And he said that if we have a negative August, which of course is not over yet, but if we do have a negative August, then technically September in those periods wasn't as bad as you thought, and it is statistically quite bad. October certainly wasn't very good, but we're still in 8 and 0 territory. So in all of these situations, there was still 100% correlation with bullish positivity at the end of the year, although the next 2 months are going to remain sketchy and very, very interesting. This is why. Let's take a look here at the seasonal trend of the S&P 500 over 25 years. You can see here September is historically the weakest, and usually somewhere around the beginning to the mid of October, we tend to see that rally. Now, this year, we're focused on this one here, which is pre-election years, and it does tend to still have that weakness into the back of September and October. And funnily enough, we're seeing some big options activity right in the October lows. I would say that the puts that are being stacked on October will make it very difficult for this market to go too much lower at that point. We'll discuss that later on today. We also know volatility tends to spike over this time. If I showed you volatility that wasn't pre-election years, it keeps spiking into the beginning of October, which means we're just in an uncertain and volatile time. We've talked about it. We knew August would be weak. At this stage, it has been. And of course, we kind of expect that maybe September and October will be sideways and weak as well. But will the price action and the charts confirm that? A key level for the S&P 500, if it breaks below, which we'll watch later, probably will bring the pain for quite a few people. And I think it'll get to a very nice buy the dip style situation, at least from a technical chart. There are also questions being asked about stagflation. You know, if we're in stagflation, what should we be buying? And people are saying real assets versus financial assets are now some of the lowest they've been in a long time. Generally, people would be going towards the commodities side and gold side in stagflation. And it's just an interesting chart to show you actually how cheap assets are in terms of those real assets in comparison to where they were in history. What isn't cheap, though, is technically the market versus the risk that we're taking to get into the market. Remember, US 10-year yield is currently amazing. It's like over 4%. S&P 500 earnings yield, questionable. So when we see things like this, we bring up things like ERP. And of course, this is a very important aspect of all investors. And it often means that you might want to have more powder dry because ERP doesn't usually remain this low for too long. Now, it did a little bit in the 1990s, but of course, there was a crash that allowed you to get back in. And I think one of the things that you're looking at here is just considering maybe Mike Wilson from Morgan Stanley's information and notes this year, where he said that, you know, when you get to these points, you might need to consider alternative assets as well, assets that give you more money, e.g. cash bonds and other events. Now, that has not come true so far this year, but it could be interesting. What about mortgage applications? Everybody's discussing, of course, housing in the US weakening off. Here's an interesting stat. Again, mortgage purchase applications are showing us that markets are really struggling here. And we're just not seeing mortgage apps getting any better anytime soon. Basically, they're the lowest level since 1995, down 50% from the pandemic peak. And what that means is that people aren't taking debt on. And if people aren't taking debt on, it generally means that in the future, the economy isn't growing as well as you would think. And this is just one of the first steps that we usually look at. We'll cover some more this week in our video, so make sure to subscribe for that. Bullish percent index, something we talked about as a turning point for this market when it got below 70, gave us kind of the idea that we were going into a significant dip. That's continued to come down. It's now sitting at around 53. So we'll keep looking for it. We're looking for it to turn on the way up to show us the dips in. That has not happened yet. What about unusual options and trade activity? Well, first up, we did have that large trade for Apple. We saw a little spike in the stock actually, which we'll look at later on. Could it be bigger purchases? Well, we'll look at the key level that we believe means the momentum is in for the dip at this stage. And we also need to discuss S&P 500. Last week, everyone seemed to be doing transactions right around that 436 zone. They also purchased the 436 again on the SPY near the close. So will this be the bottom for markets? And if we do break underneath this, are we going to be in a significant level? I believe we will. And this is a zone that we must be paying attention to. Let's also bring over the options now and take a look at everything to do with the big options flow. What happened? Oh, and this one's crazy. 166 times normal 90-day volume. Sure, that was pretty huge. But realistically, let's have a look here. 2.64 times Nvidia. There's no doubt in my mind that a lot of these calls opened are retail. They're us. And people are betting on the bullish kind of movement here of the market. So far, they're getting crushed, and that's a big deal. We've also got a large amount of trades on Tesla again. J&J remains ridiculously traded, and there's quite a few others, including Boeing, Enphase, and others. What I'm interested in is the stat down here. 50% puts, 50% calls on almost 42 million volume. So higher than average, and now it's starting to get split between the puts and the calls. Remember, if we start to see the puts outweigh the calls heavily, it means that we're probably putting a temp base in because too many puts around, too much bearish sentiment, and it's very hard to go lower. That's kind of like what happened at the whole point of this year. What about large trades? Well, we continue to see a bunch of puts probably opened for the SPY and for Russell 2000 for October. Look at these dates, 55 days away. And that seems to be the favored strike at the moment. We've brought this up quite a few times. Puts for October seems to be where everybody's sitting. Now, if that's true, we need to look at max pain for October because that could put in what we call a put floor, where markets will find, even if they sell off, it'll find it very tough to get past that zone. And it could put a good point in for us to be looking at in the markets. Imagine if we got a 4150 or a 4200 S&P 500 level. That would be pretty amazing, wouldn't it? Let's move over now to the moves of Friday in terms of what was hot and what wasn't. Gold struggled because of the hawkish tone of Jackson Hole and of course Jerome Powell. And basically what ended up happening was we saw those yields go up higher for longer. Gold hates that, so it didn't do very well. The defensives weren't really doing spectacularly either, and it was a little bit of relief for some of the sold markets, including technology and others. That brings our 5-day running total to tech still doing well, semiconductors are still doing pretty good, and gold being the leader of that period. But will it be able to hold? Well, we'll see about that soon. This is a great indicator. This basically shows us the markets at the moment and whether we're in the bottom of a dip. Not yet, according to, of course, percentage of stocks above the 50-day moving average. Usually we have that nice capitulation selling that freaks everybody else out. We go into like a 20 to 30 kind of area here of how many stocks are above their 50-day, and we'll be looking at this. There's some other metrics you can use to read this as well, such as stocks above or below their kind of 12-week, sells and all of these other kind of levels, and that could often tell us temporary bottoms. At this point, we just don't have it yet, so we'll be watching, and of course, we'll be paying attention. The skew continues to be on the side of the bears at this point. Skew crush continues. We're looking for big crushes to come through. If that does happen over the next 1 to 2 months, whenever that does happen, you're looking for price action to then confirm it. That is go down. If that happens, well, you know what's probably going to occur. The market will move to the next level of equilibrium. We'll talk about some of those very, very soon. US 10-year continues to play with the top. If this goes into the fear of the unknown, well, we know markets won't like that. I think the US 2-year is really worth watching as well. This weekly close was a big deal. It actually closed at a new high. So that's a new high, guys. That is a new closure high. It's not a wick with a rejection. Jackson Hole, Papa Powell, he did it. He pushed it through. And that means that we could be in a little bit of a freak out, especially if this continues to go up. Some people are now predicting 6% terminal rate, even though the market's not quite there yet. So it's all changing and things are happening. Here is the December expectation, 5.48 now on the markets. And what are we approaching back to? Near highs, near all-time highs. This is a really wild statistic. If you could talk to us at the start of the year or you talk to anybody and you said, look, yields will be going up, then we'll get some kind of bank crisis. Then on top of that, yields continue to go up and the market will therefore have recovered almost all of what it dropped in 2022. People will be left scratching their head saying, how's that possible? Well, it turns out the market's very, very crazy, but at the same time, we've also got a very hot economy still, and we just don't see that unemployment dropping. So at this stage, coming into this week with non-farm payrolls, that will be a big number. Once we start to see unemployment spiking up here and getting worse, that will tell us that a recession is generally around 3 to 6 months away. It's been a pretty reliable stat. So we know that at this point, well, unless yields uninvert, which is something you're looking for as well, the US 2-year versus 10-year, or that occurs, we're not near a recession just at this stage. Copper put in a daily long leg doji. You're going to see a lot of these, a lot of indecision waiting for next week, and of course waiting for movements, but copper still at the 20s, so still technically in the downtrend at this stage. The US dollar was strong, very strong, moved into the 104s, which was our next target. Found a bit of a rejection, but there wasn't enough to say, oh yes, this thing is turning around just yet. We do have, of course, this high, low, kind of high, low, low scenario. It's possible there's a seller in here, but I wouldn't bet against the US dollar while yields are going up. Until we see yields turn, it's going to be very hard to position a long-term short on the dollar, although a lot of big investors and big traders really believe that's possible. Gold still sitting around the 20 moving average, again reacting to the Powell speech, reacting to yields, having a bit of a hard time around the daily 20. We'll update you as we see fit on this one. No movement yet. And GDX, so gold stock, where things look a lot more exciting, still looking for a 29.80 close above. And if that happens, then we'll be looking towards bullishness in gold and probably yields dropping across the board. I think that'll be an interesting chart. What about oil? Well, oil reacted pretty positively, which we kind of expected to. Maybe 81 a barrel's coming this week, and that's where the sellers have shown commitment before. So we're looking towards, a sell at that point if it does happen, down to around the 73 a barrel. So it could be significant, certainly something we're paying attention to. If we get a new high though on here, then we're going towards, I would say, like 92 a barrel. Tesla, put it in, nice big buy, coming right off where it had to hold, and we continue to remain in what we would call a coil. So now we're in a 1-1-2-2. So we're basically in a channel or a coil. We have to expect that sellers are committing around 240 to 242 and buyers are committing around 230. So it could be some good trading here until Tesla breaks out. And when it breaks out, especially if the coil keeps going for a few more days or a week or two, then we'll have a very strong move. So still looking towards 200, 210, daily 200s, these levels down here, which you can see very, very nice zones. But we don't know if it's going to turn just yet. Didn't manage to get below the low. What about hypergrowth stocks and tech and all these kind of gambly style stocks? Well, RK is on a very interesting level. Of course, we know this is a downward trend line overall with some strength that's been in there. We've got a very heavy trade zone, and we know there's been a lot of volume through that. So this just shows us a bit of a barometer of how things are looking. Stocks like PLTR, SoFi, etc., they might be weakening a little bit on charts. And these are popular, areas. Of course, you could start to argue head and shoulders for a lot of these. If that happens, $10 is not out of the question for PLTR. So a lot at stake depending on what the S&P 500 does. Let's look at now semiconductors. The best market sector now looks kind of weak. I mean, that's a rejection from these highs. And if you pull something like a fib, which we'll do right now, let's put a fib on here together. We can basically say, well, this market has picked up pretty strongly during the week and then rejected a really nice fib. We rejected the 61.8 fib. That's very, very common. And this doesn't look exactly good. Imagine if we then put a new low in this week. Oh, let the flows begin. All of a sudden back down to 132 potentially very quickly. That would be a big deal. And we're going to see a lot of this as we look through the indices as well. AAPL, a little bit stronger. We did report on a large trade here. Was it a buyer? Probably. Will they hold it on? I don't know. But if we get back above these highs, we often say what the biggest stock in the world does is super important. It was weak. The rest of the market became weak. It's now strong or strong-ish on the day. Maybe it's getting a bit better. If we make a new low, though, watch out down below. Of course, it's going to be all big. So Apple, still very important chart. A little bit of a bounce. I'm not sure I'm convinced by this one, but it still is bouncing off the right area. What about the Chinese market? Still holding in its own kind of pattern. It's just sitting down in the lows. Nothing much to report back on the Chinese market at this stage, although we are looking for stimulus in that economy. But let's move over to the German. Now, this was one of the best trades of last week. This was an exceptional level. I did say I very, very much liked it, and it was great. We also expected a bit of a bounce, so that's fine. Weekly looks familiar to the other ones, and of course, the pattern at this stage would be telling you, well, you still need to be looking at the weakness and the strength on the, more the swing trade. And the reason why is because we've got that kind of melting up market. It was weakening. It had the BC, probably UT, UTAD. And as we know, if we are making it through this low down here, which is just underneath 15,500, then we could be going to a significant sell-off. That could push us to a 14.5 fairly easy for the DAX. So significant risks ahead if markets are to get underneath, but they do hold on their buy pressures at this stage. So buy the dip is still a big thing. Australian market audience, before we go into the US, long leg doji for the week. That means no idea about this market. It doesn't know what it wants to do. It wants Chinese stimulus, but at the same time, it's scared of the US market weakening. You can see here, the long leg doji, close above or below will be significant. US 2000 took a new low and then rebounded through. Very interesting chart this week. We'll be marking out 1870, probably, actually, let's just get the price here for everybody. We need to mark out basically this week high, so about 1879. and we'll need to know if the market breaks above there. That could be incredibly significant considering it took a new low, and if it does rally, even though it's a long leg doji at this point, again, indecision after Jackson Hole, then yeah, we probably know that the bottom is in, at least at this stage. S&P 500 and Nasdaq time. Nasdaq, beautiful sell-off here. Very strong rejection. Not quite super strong, so you'd usually want to see this actually close near the lows. And if you go to the futures, you'll see what I mean. The trade was weird. It like went up after Jackson Hole, then sold to make a new low, and then kind of rebalanced itself back up again. I would have liked to have seen that sell commit further if the bears were really in control of this market. We initially expected the rally to happen, and I liked it. I liked the rally. I kind of thought maybe we'd get a 15,100 first and then sell off. But it was actually a bit lackluster after the whole hawkish stance, and obviously Jerome Powell didn't really say anything too new. Everybody's drawing this one, head and shoulders on the S&P, left shoulder, head, right shoulder. If that came true and we did actually move that way, and of course we know what's at stake, we're all talking about 43.30 as a key level, then we could be taking the distance from the neckline to the head, extrapolating that out, and funnily enough, or not funnily enough, it comes back into where that massive coil was from April and March. This is what I think most traders would be targeting. There's so much to like about this level, but at the same time, bears, you need to get below this zone. Now, was the weekly bad? Let's have a look at the weekly here. It was another rejection candle, but it needs follow through. So again, 20 moving average, 43.30. We know what's at stake here. We don't have the catalyst, but I think if this gets underneath, the chances are the markets are going here. If the buyers can hold it here, then of course we might have just seen the lowest dip for now. Okay, and we expect usually a double dip at this time of the year. Let's go to the futures action now. Look at the 2 hour. It was again a bit of strength, bit of weakness, bit of strength. Again, very weird day. Nothing much to go from there. We kind of thought that maybe 44.34 was a possibility during the session. I still think that's a possibility. So this is still a possibility. With a low put in like it did, you're looking now towards probably getting a little bit higher. And even if this sells off, seeing what happens here around 43.90, we'll be watching that one. That's a possibility. New lows, 43.30 being super key. And of course, if we make it above this high, maybe we do have the low in. We'll be looking at the price action because, of course, that will snap last week's weekly close off. It would, or weekly high off. That would be very, very bullish, I think, for these markets. Let's move over to Bitcoin. Now, Bitcoin's been stuck a lot. I don't really like this chart at the moment. I do like Bitcoin, though. We've got a little chart coming up in a second. We will do a coverage on it, though, soon. No new low find. Definitely in coil. So the market will move pretty strongly when it comes out. But historically, this has still been a weakness period for Bitcoin. So if we have a look here, and this is, of course, a rainbow chart. You might say, why are we looking at a rainbow chart? Well, what I'm more importantly looking at is cyclical events. So we tend to see a pickup that happens about here, and it happens, and then it kind of sells a bit into the halving event. Well, we did see a pickup. Now we're staying a sell-off. And what I'd like to do is to see it actually further weaken, similar to other times. Then around that kind of January, February of next year, we see that kind of nice dip potential for the pickup for Bitcoin. Remember, the halving event is coming. It's basically in the first quarter of next year, as you can see here where it's going to be. And what we're looking for is we're looking for a bit of weakness actually into that period. High yields for longer, not good for crypto, and certainly I think could bring Bitcoin down further, especially with the Chinese news being so weak, and that smashed it around with the Evergrande situation. Let's now move down to the biggest news or events for the week. This is all in New York time. You can see there's quite a few big events coming out. But I think nothing is as big as things like core PCE price index, which is on Thursday at 8:30 a.m. And then we scroll down, and of course, we've got non-farm payrolls. Now, this will be a big number because, of course, we're looking for the economy to actually be weakening. At this point, it hasn't been. Unemployment's remained good, if not amazing. Job growth has remained amazing. It's been a huge reason for why the markets have just remained so strong. But the Fed is targeting this to weaken. That's what they're trying to do. So have they actually seen it? Remember, when unemployment starts spiking and it turns, we're generally around 3 to 6 months off a recession being called. And is that important? Well, it is kind of, because, of course, bonds markets still predict that. That's what they're predicting. It's not our opinion. It's what they're predicting. So we need to, therefore, potentially be investing in that idea and paying attention to the market price action. But for now, what I think is clear is that most macro people are completely confused. No doubt we all are, because it is a very confusing time. So we need to follow the price action. And I've seen that in almost all of the biggest reports coming out from the big banks. All of them are saying we're following price at the moment. We're going to lean more on price than the macro at this stage. Thanks so much for watching. If you enjoyed today's video, make sure to subscribe. We'll see you in the next one. You have a great week ahead and a great weekend, of course. Bye for now.